So how do you manage $1 billion for the next 10 years? It's not about chasing the latest hot trend or getting lucky. Nope, it's about building a fortress. Today, we're going to pull back the curtain on the actual architectural blueprint the world's biggest investors use to build unshakable, long-term wealth.
Okay, let's just make this real for a second. Imagine $1 billion just appeared in your account. The goal isn't just to make it grow, right? It's about protecting it for an entire decade from all the crazy storms the market's going to throw at you. So what do? Do you bet it all on tech or play it super safe with government bonds? The options are, well, they're endless, and the pressure is just immense. One wrong move could be a total disaster.
You know, the pros, they don't gamble on hot tips. They rely on a process. It's called Strategic Asset Allocation, or SAA for short. And this isn't just some flimsy plan. Think of it like the architectural blueprint for a financial skyscraper. It's designed not just to reach for the sky, but to have a foundation so deep and so strong it can withstand any earthquake the market throws at it.
Any good architect knows their first job isn't to start drawing, it's to survey the land. And it's the exact same thing with investing. Before we can even think about building our strategy, we have to understand the financial landscape we're building on.
So, what does this roadmap actually look like? Well, it's basically a 4-step journey. First, we start by looking at the big economic picture. What's going on in the world? Then, and this is crucial, we get really honest about our liabilities. What do we owe, and when do we owe it? Only after that do we start painting with broad strokes, sketching out our mix of assets. And finally, we put the whole thing under a microscope for a really comprehensive review.
Okay, so we've surveyed the land. Now it's time to choose our tools. But we're not talking about hammers and saws here. In the world of finance, our tools are these incredibly powerful models that let us peek into thousands of possible futures. And believe me, choosing the right one can make all the difference.
We've basically got 3 main tools in the toolbox. First, there's mean variance. Think of it like a classic, reliable hammer. It's simple, it works, but it's not always the right tool for a really complex job. Then you've got multi-period optimization. This thing is like a super advanced laser cutter. Incredibly precise, but it's so complex you might not even know what to do with the results. And then there's the Monte Carlo Simulation. This is the versatile, all-purpose power tool of the finance world. It's the go-to for a very, very good reason.
But here's the real kicker. The reason simulation wins out so often isn't just because it's mathematically elegant. It's because it's human. It's transparent. It lets a room full of actual people look at a bunch of different what-if scenarios and just have a conversation. So the big takeaway here? The best tool isn't always the one with the most complicated formula. It's the one that helps people make the best decisions.
All right, we've got our tools ready to go. Now it's time to actually draft the blueprint. This is where the magic really starts to happen. We're about to map out that perfect balance between risk and reward, to find what some call the holy grail of investing, the efficient frontier.
So what in the world is the efficient frontier? Honestly, just think of it as the ultimate menu for investors. For every level of spice or, risk you're willing to handle, it shows you the absolute most delicious or profitable dish you can get. It's our guide to ordering the perfect investment meal every single time.
Having a map is great, but we still have to choose our destination. And that all starts with a really simple question. How much pain can we actually handle? For the institution in our case study, they drew a line in the sand at 27 billion won. That's their value at risk, the absolute maximum amount they are willing to lose if things really go south.
And you know what? Once that line is drawn, the rest is actually pretty easy. We just find that exact spot on our efficient frontier blueprint, and voila! The model tells us the perfect mix of assets to hit that sweet spot of risk and reward.
And here it is, the big reveal. To stay inside that 27 billion risk limit, the blueprint says put 195 billion in stocks and 204 billion in bonds. Now this isn't a guess, it's not a hunch, it's the direct result of all that rigorous analysis we just talked about. This right here, this is the foundation of our financial skyscraper.
But a skyscraper isn't just a frame, right? It's got to be reinforced to handle earthquakes and storms. In our portfolio, one of the biggest potential earthquakes is credit risk. That's the chance that a company we've lent money to just goes bust. So we need to build in some serious shock absorbers.
To do that, we use a tool called Conditional Value at Risk, or CVaR. Think of it this way. Our first risk measure, VaR, tells us if a storm might be coming. CVaR tells us how much rain we should expect if that storm actually hits. It's all about getting ready for the absolute worst-case scenarios, the financial hurricanes.
So let's take a look under the hood of our bond portfolio. This is the before shot. As you can see, it's packed with super safe AAA-rated bonds and then a little smattering of other grades. I mean, on the surface, it looks like a pretty safe bet, right?
But then we run our optimization model, and we get a surprise. The after portfolio is what's called a barbell. We actually increase our holdings of the ultra-safe AAA bonds and the riskier BBB bonds, while selling off the stuff in the middle. Now, why would we do that? Well, it turns out it's a more efficient way to get the returns we want without taking on unnecessary risk. It's kind of like building a bridge with two really strong pillars instead of a bunch of weaker ones. Okay, we've built in our earthquake protection. Now it's time to brace for those financial hurricanes. Interest rates. You know how it works. When interest rates go up, the value of the bonds you already own goes down. It's a classic seesaw. So we have to be super strategic about how long we're tying up our money.
And that brings us to a really crucial decision. Do we play it super safe with ultra short-term bonds, or do we go for the long haul? As you can see here, the options range from what's basically a quick 3-month sprint to a multi-year marathon, and the path we choose is going to have a huge impact on where we end up.
So, after all of this work, the surveying, the modeling, the reinforcing, what does it all actually add up to? Let's look at the final results. This is that moment where we really see the difference between a carefully crafted strategy and just a shot in the dark. The results are in, and on average, taking on a bit more risk seems to pay off. The long-term strategy, that blue bar way over on the left, is the clear winner when it comes to projected profits. And honestly, if you were just chasing the highest number, you'd probably stop right here.
But, and this is a huge but, investing isn't just about averages. It's about being able to sleep at night. This chart shows what happens in a worst-case scenario. And look at that. The story completely flips. Suddenly, that winning long-term strategy is at the very bottom of the pile. The safer, short-term approach, well, it offers much better protection. And that's really the ultimate lesson here. There's no such thing as the single best strategy, only the best strategy for you.
So what's the big picture here? It's this. Strategic asset allocation isn't about having a crystal ball. It's about having a blueprint. It's a disciplined, repeatable process that uses powerful tools to get ready for a whole range of possible futures, always with an eye on that delicate balance between risk and reward.
And that really brings us to the ultimate question, doesn't it? In a world where the only thing that's certain is uncertainty, where do you place your bets? On a flawless prediction that might never come, or on a bulletproof process that's built to last? The answer to that question might just be the most important investment decision you ever make.